Well, good afternoon, everyone. Thank you so much for joining the call today. We are extremely excited to be back together for part three of our four-part wealth building series. Now, please note, if you have not already watched parts one and two, part one is the language of finance, and part two is your wealth engine. Both of the replay videos of those episodes are available on our website, apriem.com, and they are located under the Education tab, where it shows educational webinars. My name is Josh Garland. I will be your host today. Before we get started, just a couple of short housekeeping items. First off, we schedule 1 hour for the presentation today, but about, let's say, 40 minutes or so will be dedicated to the presentation, which will leave us about 20 minutes for questions at the end. Now, we encourage you to go ahead and submit your questions throughout the course of the presentation. That can be done so by using the question tool that is located in your dashboard. Today's presentation will be recorded and will be added to the Apriem website. It'll take probably about a week or so for that to show up there. Also, at the end of the call, there will be a survey. We encourage everybody to please leave your comments and feedback. We do take them seriously and try to add any suggestions that you have to continue to get better and bring you better content along the way. Now that we have covered those short items there, let's go ahead and introduce everyone. Once again, my name is Josh Garland. I will moderate the show today. I'm one of the financial advisors here at Apriem. I joined the team a little over 2 years ago, but I got my start in the industry back in 2009. And in 2013, I became a financial consultant and as well an accredited investment fiduciary last year in 2020. Now, I'm joined by Christopher Whitaker and Megan Schwab again. Chris is our lead financial planner here at Apriem. He is both a certified financial planner and an accredited investment fiduciary. He obtained his bachelor's degree from Point Loma University in San Diego, California, and his advanced credentials from Boston Institute of Finance. Before coming to Apriem, Chris worked at a high net worth planning firm where he was trained in each of the financial planning domains. Chris is married and has 2 small children that happily take up all of his free time. At his side, we have Megan Schwab, who is an associate financial planner for Apriem Advisors. She graduated from Biola University in 2018 with a BS in accounting. Megan got her start in the industry as an intern here at Apriem and officially joined our team in January of 2020. With that, I would like to go ahead and turn it over to the two of you to get us kicked off and going.
Thanks, Josh, and thank you everyone for joining us today. This series has been so exciting to be a part of because we've consistently at least a few generations on each call with us, which has been great. Obviously, we're honored to be presenting such a wide range of people. And so thank you for all of the wonderful feedback, and we're just thrilled that you've enjoyed it so far. So today, as promised, we're going to turn up the complexity a few notches here and get into more advanced granular strategy around wealth building. But before we do that, we want to again revisit one of the main reasons why we created this series in the first place. And obviously, Apriem prides itself on helping entire families get on the same page with their finances. And there are some very alarming statistics that Megan's going to cover in a second, pertaining to how most families lose wealth as inheritance passes to future generations. And here at Apriem, we feel like we have the antidote to that problem. And what we found is that by educating each generation and meeting them where they're at in life to be better stewards of wealth, it's just such a powerful concept to be protecting multi-generational wealth by first mentally understanding how wealth is built and maintained, and that person is exponentially better prepared to receive wealth without ruining them or squandering it, really. So with that being said, I'm going to pass it over to Megan to share some interesting statistics with us.
Thank you, Chris. So for those of you who have been on the past few calls with us, this page looks very familiar. But just as a reminder, and for those of you who may be joining us for the first time, these are some problem statements that, like Chris said, we feel we have the antidote to fix. So the first one is 90% of wealth is lost by the third generation. 48% of Americans have less than $10,000 saved for retirement. Bankruptcy rates soar for lottery winners 3 to 5 years after they've won. And I think the most alarming one to me is that 27% of adults would need to borrow or sell something to pay for an unexpected expense of $400.
Those always get me still. So with that being said, let's dive into part 3 of our series, which we call Advanced Wealth Hacks. So before we go too deep here, I just want to start with a really important disclaimer. So when you get into specific strategy in financial planning, you start to get into very specific tax and estate planning laws. So while everything we're talking about today exists in January 2021, obviously the strategies we're going to cover and go over may not make sense or even be possible, as laws and frameworks in finance inevitably change over time. Also, please meet with an advisor one-on-one to make sure attempting any of these strategies actually even make sense for you in the first place, because all these advanced strategies that we're going to go over obviously have an enormous amount of nuance involved. And so with that being said, we're excited to deliver on our early promise. In part one, we're going to dive deeper and deeper and turn up the complexity over time. And so I hope that even the most experienced investors listening to this particular part of the series pick up at least a couple of new items that they weren't aware of before. The ideas in part 3 are going to take the core language of part 1 and then take the scenario of part 2, where we kept it kind of simple on purpose. And then today we're going to explore ways to expand and compound wealth even faster and more efficiently than we did in part 2. And so to kick us off, we're going to go with we'll start with retirement account tips here. I'm going to pass it to Megan to talk about a complex type of conversion.
Thank you. Yes. So we're going to talk about different types of retirement strategies. And as you may remember from the first webinar in our series, there are so many different types of retirement accounts. And each one has their own rules and potential utilization strategies. So in this section, we're going to just explore a handful of advanced examples. And I'm going to start with something called a backdoor Roth conversion. So backdoor Roth conversions allow for high earners to legally get around the income limits for contributing to a Roth IRA. If you remember from our first webinar, the Roth IRA does have an income limit. And if you pass that, you need to switch and start contributing to an IRA instead. And as we will see with most of the topics covered today, this backdoor Roth conversion is possible through the coordination of different tax codes and laws. So you'll see some of these first two bubbles are acronyms. So I'm going to go ahead and get into the first one, called TIPRA. This is the Tax Increase Prevention and Reconciliation Act of 2005. And this was a law enacted in May of 2006, and it is actually what allows the conversion from a traditional IRA to a Roth IRA to happen in the first place. Prior to 2010, there was actually an income limitation on these conversions. That limitation has since been removed so that anyone with any amount of income can do this type of conversion. And that brings us to the next tax law, which is the Tax Reform Act of 1986. This law was passed during the Reagan administration, and it rules that tax deductions for IRAs are phased out for high-income taxpayers who have an employment-based retirement plan. So there's a couple of things I want to note here. The first is for married couples. So if you work for a company and you receive that employer-sponsored plan, but your spouse does not, whether they work for a different company who doesn't offer it or they don't work, you're still subject to these tax deductions, meaning that they will be phased out for you. Just because one spouse doesn't have it doesn't rule you out from this option. The second is that while a tax deduction is phased out for high-income taxpayers, the contribution is not for a traditional IRA. So a high earner can still contribute to the traditional IRA, but they would not receive the tax deduction after a certain point. And I think it's really important to remember that the purpose and true benefit of the IRA is to have deferred tax savings for retirement. And the tax deduction is just the cherry on top. So, it's great to take advantage of that while you can. But just because you're phased out of that deduction doesn't mean the IRA no longer, makes sense for you. It's definitely still a great idea. And so these are some of the laws and rules behind the conversion, and the next two things I'm going to go over more of the mechanics of it, and what helps make it work. So the first is IRA aggregation. So this is the part of the tax code that says when you are determining the value of your IRA accounts, every IRA account you have will be aggregated or grouped together for tax calculation purposes. So you see in this example here on the left-hand side, this individual has an IRA worth $67,000 after-tax dollars. And on the right-hand side, they have another IRA worth $5,000 after-tax dollars. So when figuring out how to take when to take your withdrawal and how much, you need to aggregate or group together those IRAs. So you'll see in the circle in the middle that the total amount in this individual's IRAs is $72,000 combined. And the next slide will actually explain the second half of this graph. So that's where we get into the pro rata rule. So the pro rata rule is a formula that determines how much of a distribution is taxable when the account owner holds both pre-tax and after-tax funds in their IRA. So you can see here that this individual in this example has $20,000 in pre-tax IRAs, and then they have $6,000 in after-tax. So when you add those together, or when you divide 6,000 from the total, the aggregated total in all these IRAs, the non-taxable portion of this conversion would be 0.23 or 23%. So what you would do to determine the taxable portion would be 6,000 times 1 minus 0.23 to get this 4,620 taxable portion number. And as you keep withdrawing from your accounts, this formula is relative to how much after-tax dollars and how much pre-tax dollars you have in your account. So that amount will always change as you keep withdrawing. So with that, Chris is going to go over some other retirement hacks.
And just to kind of, so to bring it back to our part two for just a second, so for Adam and Allison, right? So for Adam and Allison's situation in part two, we didn't have them do any of this. We just had them contribute to whatever their income allowed them to contribute at the time. But why would someone even go through all these different steps to do this? Well, at the end of the day, what's happening here is if your IRA aggregation and pro rata rules are taken care of and your IRA runway is clear, then that means that you can actually end up, no matter what you're making, have the benefits of tax deferred growth, but then also at the end of that tax-free income on the back end, because that's what the beauty of the Roth, right? And so basically TIPRA and TRA set the stage to where you can make non-deductible contributions in the first place, and there's no income limits on conversion. And then IRA aggregation and pro rata come in and say, okay, hold on a second, here's the caution sign. Let's make sure that we're okay on aggregation and pro rata. And if all those are taken care of, you get this nice, kind of complex conversion that ends up compounding wealth much more efficiently over time. Yeah. All right. And so this next one here, I'm excited about this one. I get to talk about a new kind of twist on 401ks and really lift the hood of the car and dig into the engine behind them and what's really happening underneath the hood. Because I think, so what's interesting about 401ks is I think most people just think, okay, so it's the employer plan, and everyone kind of understands that there's this employee contribution. Right now, it's currently capped at $19,500 per year, but there's so much more behind 401ks that are potentially there. And so, the general rule typically boils down to save as much as you can and be certain to capture any matching contributions at a minimum, right? However, what's been happening lately, obviously, I think everyone is aware of this, is that we have this gig economy that's evolving, right? It's becoming more and more common to have more than one job or to have a side hustle. And so for that subset of workers, there's a possibility of being covered by 2 or even maybe more than 2 401ks or plans. And so when you have different defined contributions plans at the same time, either for those that have an employee job with 2 different businesses, right, or because you have the side hustle, it becomes this really important question of how do you coordinate, or even can you coordinate between these multiple plans? And that's really what this is about between 402G and 415C. So that's kind of the background. And so what you see on the screen here, this 402G represented by the red box. Again, that's the more common thing to think of, right? Is this $19,500 annual limit, this pre-tax, or maybe even Roth too, depending on the setup, right? That's the employee part of the contribution. But what happens if someone has their main W-2 job, but then, Jane Doe here in this example has 2 jobs, then she has a side hustle. So what ends up happening, she could actually have a separate 401k set up for her side hustle. Maybe she's doing business as a sole proprietor with a DBA or something like that. And the 402G applies across all the accounts, but the 415C is per plan, right? And so you could have a much higher total savings, and it's incredibly tax efficient. So like, what could this look like? Let's say Jane is very successful and has a decent amount of income both from her main job, and also her side hustle also earns 6 figures, something like this, right? She could, in theory, max out her main W-2 job in the 19.5, right? Then maybe she gets some kind of match or profit sharing on that one company's job, and that's when the 401(c) kicks in. So there's a little bit more than the 402G limit put in that one. And then for her side hustle, that 415C limit allows her to put in, I mean, if she's under 50, 57,000. If she's over 50, be 63,500. So in that hypothetical situation, maybe Jane's able to put away almost 80 grand or more into a 401k setting. And once again, we learned in the previous sessions that when you put money into a 401k, it's very efficient because it's lowering your taxable income and then growing tax deferred. It's the ultimate deduction. It's an above the line deduction right off the top. And so you can start to stack these. So just to give an extreme example, technically it would be possible. Like, let's pretend someone had 10 different 401ks. There's no limit to this 415C example. Now, there's a huge caveat here we're not going to get into on this call, but you want to be careful about the ownership percentage that you have with each company with that plan. So there are some nuances here. So again, don't attempt this without really thinking it through and making sure that you're talking to a tax professional. So that's the 402G and 415C.
So just to kind of recap that,
yep.
Just to make sure that I'm thinking about it the right way. Let's pretend I'm working for an employer. I'm not an owner. I have no ownership share in the business. I'm just an employee.
Mm-hmm.
And I'm at a point where I'm maxing out my contributions to my 401k.
Right.
And then at home I'm as a hobby I'm an artist. And whether I do paintings or sculptures or something along those lines, I sell those on a regular basis and I make some additional money or income on the side.
Mm-hmm.
I could technically have that set up as a business, set up a solo 401k,
mm-hmm.
and using the 401(c), 415C, I could contribute over and above the 19,500 that I'm already contributing.
Correct. Yep. Yeah.
Okay.
In that situation, yep, you'd absolutely. Your main job, you got the normal 19,500, and then you could use that 415C for that side hustle. And by the way, I would love to buy your art, Josh, if you want to start.
I'm sure your son does.
Okay. All right. The next one is net unrealized appreciation. I'm sure everyone's rolling their eyes at our banter right now. So this one here is a really powerful one. It's a really cool tax break, that potential tax break. So this is IRC section 402E4, which is properly net unrealized appreciation, or NUA. And really, it's the simple sentence is the difference between the original cost basis and the current market value of shares of employer-traded stock. So again, to set the stage here, the caveat is you have to be working for a publicly traded company for this to even be in the realm of possibility. And then the next qualifier would be you have the ability to purchase stock in the employer plan, or maybe you're being given it into a pre-tax ESOP or something like that, right? So it's got to be the right kind of mix of ingredients there for this to even matter. So let's assume, though, for the case that this matters, and this is a great example. In part 2, Adam worked for a publicly traded company. We didn't talk about this before, but what if Adam chose to set up NUA for himself? What would that look like, and what are the potential benefits? So you can see on the screen here that you have this taxation of net unrealized appreciation on the left-hand side mixed with 3 different colors, right? So that's kind of the bucket of, imagine those 3 colors being one share of stock. So for each share, you have a cost basis, right? What you paid for it. You have the net unrealized gain, that's the tax-deferred capital gain inside of it. And then there's the potential for post-distribution gain once you've rolled over into a non-qualified setting, right? And so you can kind of see, if this was just a normal, forget NUA, just what happens inside most 401ks is, right, let's just say this stock is worth $100 even for even math. When you pull that money out, you pull that share out, you have $100 that gets added to your ordinary income. But in NUA world, you actually would only pay ordinary income on the cost basis, and then all of that unrealized gain can be a capital gain, which is really powerful. So on the right-hand side, you can see the math of a potential scenario on why we're talking about this. So you have this situation where someone has ordinary income tax on $500,000, and let's just, this is oversimplified, let's just say it's 35% effective tax rate, right? And so on that $500,000, you'd have $175,000 in total tax if it was just normal setup. But what NUA provides is this split on the taxes. So you have 35% ordinary income tax on the cost basis, or the blue color on the left-hand side, right? Then you have capital gains tax on the NUA, or that orange yellowish color on the NUA gain, right? And so the math broken out in that way would only be $100,000, or $43,750 plus $56,250. And so in this example, just by doing one specific code or one specific kind of situation here, they're saving $75,000, which is a huge percentage of that distribution. And so I think this is interesting because oftentimes, as planners, I think in general, a lot of times people come to us towards the end of their career when they're getting ready to retire. But if you're a younger accumulator listening to this or seeing this right now, then you could actually set up NUA on purpose for yourself, not accidentally fall into it. So if you're working at some publicly traded company and they happen to let you buy some stock in a 401k, it could be a great idea to on purpose accumulate inside of that account. Keep track of your cost basis, and then you can later on down the road take advantage of NUA. Yeah. And that is IRC section 402E4.
I like it.
All right, let's go to the next section here. And so this next one is real estate and business. So again, from part 2, on purpose, we had Allison started a little side business, and then we also had them purchase rental property to introduce multiple asset classes into their plan. And so we're going to go over what they could have done or could have set up on purpose, or what they could be taking advantage of from that situation. And so obviously everyone can see on the screen here, right, that really the strategies to use here in this situation provide both tax and cash flow efficiency, which is great. So I'm going to talk about something that's interesting called a phantom expense. So let's go in there. So a phantom expense is basically something to where on paper it's an expense, but you're not actually like writing a check or actually paying for that expense. And so it counts against income. So on the left-hand side, we have an investment property where it's the real world example, right? So like this is what happens for this person's bank account, right? Forget the tax form on the right for a second. Just look at what their cash flow looks like, right? So they have $30,000 in gross rent come in. Then they have all their operating expenses, of course, cleaning and maintenance, insurance, yada, 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 right? All this list of legitimate, that stuff that they actually had to write a check for that was paid out of the bank account. But then you see this phantom expense of depreciation of $9,600. So what they would have experienced from a cash flow perspective is they would have had a positive year of $5,500. But what they get to report on their tax return is a paper loss. So that's like the $5,500 they get to keep, but on their tax return they have a negative $4,100 that counts against other positive income. And so on the right-hand side, you can see what a hypothetical Schedule E looks like. And it's an old Schedule E. I think they're changing it this next year, but this is what it could look like. So rents received, right on the top, you have $30,000, and I'm just copying line for line different expenses there over to the right-hand side, listing the other category of dues, and you come up with total expenses on line 20 of $34,100. And then you subtract the difference, right, between 3 and 20, and you get negative $4,100. And then that's line 22, which is the deductible rental and real estate loss after limitations. And so I'm just going to assume they have no limitations for this simplified example, and so you get that $4,100 as the negative. So it's just a really powerful, and this is real estate, but there are other kinds. So another popular one would be like if someone is self-employed, you hear about this all the time. Like maybe they have a depreciation or expense on a home office or part of their home. Maybe they are running expenses that they would normally do anyways, but they're running it through the business. So it's actually counting against income, and you get this pseudo tax deduction because you're lowering income efficiently for those expenses. And so I think the moral of the story here is if you be strategic about it, you can actually, some expenses can be productive, and they can also be phantom. So, and with that being said, I'm going to pass it over to Megan here for the next category, and she's going to talk about section 1202.
All right, so I'll go ahead and just jump right into this, to our section 1202 exclusion. This is also known as the small business stock capital gains exclusion. So this allows capital gains from qualified small business stock to be either fully or partially excluded from federal taxes. Those same capital gains would also be exempt from the net investment income tax that is applied to most investment income. So the first question to answer here is, what qualifies as a small business stock? So there's several qualifications, but I'm going to list a few of the notable ones here. So one is that it must be an active C corporation in the United States, so not a holding company. The type of business practice that this business does is limited to manufacturing, retail, technology, and wholesale. The C Corp must use 80% of its asset value in the active conduct of the business, and the C Corp's gross assets cannot exceed $50 million. So again, these are just a few of the qualifications to be recognized as a qualified small business stock, but they are very important to keep in mind. And there are actually also some conditions for the shareholders of this stock. So the investor must be an individual, or it could be a grantor trust. And in order to get the exclusion on the sale of that stock, the investor must hold the shares for at least 5 years to qualify for that. And the amount that is excluded is based on the acquisition date. So all in all, in its simplest form, this can be an incentive to invest in small business, to start a small business, or to even gain equity in a small business. So the government wanted to make sure that there was an incentive for small businesses to thrive, as well as an incentive for investors to actually, put money into that.
Yeah.
And if we're going back to the Adam and Allison example, if you recall, Allison did start her own small business, and say that business grew, large enough to where she could make it into a C corporation. This could be a potential option for her to use.
I think this is a cool example of how the tax codes often try and balance themselves out too. So sure, I think a lot of times you'll see C Corp and think of double taxation as somewhat inefficient, but then you hear about these other things, right, where it kind of balances that scale. I think there's a lot of teeter-tottering effect throughout the tax codes, and so this is a cool example of a counter. And I guess I'm using the word cool loosely, huh? Most people wouldn't think this is cool. Yeah.
Well, it's kind of funny that the majority of conversation today is all about taxes, saving on taxes, and Chris is over here talking about how cool saving on taxes is.
Chris is my wife's listening, and she's going to be rolling her eyes. Yeah.
Okay, and the final topic for the real estate and business section is something called a 1031 exchange. And this is actually a topic we often talk about in client meetings. So what a 1031 exchange is it allows someone to avoid paying capital gains taxes when they sell an investment property and reinvest those proceeds from the sale within certain time limits into a like-kind property worth equal or greater value. So the only types of property that qualify for a 1031 exchange are properties held for business use or investment purposes. So you couldn't do this with, say, your personal personal home or residence. So if you see this graph here on the screen, and it kind of explains the different steps that you have to go through in order to make this 1031 exchange happen. So first, the seller of the investment property needs to find a buyer, and they have to obviously close on the sale of that property. And then next, once that sale has closed, the seller then has 45 days to either close on or identify in writing a potential replacement property. And if they have not done that by the end of the 45 days, the entire exchange is disqualified, and that seller would actually have to pay the taxes, the capital gains taxes on the property they sold. But however, if they did find the property within the 45 days, they closed on it, then that would be a legitimate 1031 exchange, and the only back-end work for them would be the tax forms they have to fill out at the end of the year. But again, this 1031 exchange has a lot of nuance. So there are a lot of different, types of actions you can take when doing a 1031 exchange, but it all depends on your situation and what you're looking for when it comes to this kind of decision.
I think for everyone tracking the series, right, again, just bringing it back to Adam and Allison part 2 real quick, right, this is, we had them just kind of do simple sales if they were for their rental properties throughout that plan, but in reality what they could have done is something like this, where the whole point of this is to be able to defer capital gains and keep more of that principal snowballing as you build wealth, right? I think you're seeing a pretty common theme here, where you're either deferring gains, or canceling them out, et cetera, just to keep as much of that wealth continuing to compound, to take advantage of the power of compounding. Yeah.
Definitely. All right, and now we're going to move into our final section for this webinar, and that is the estate planning section. So planning ahead on key estate planning issues, again, can lead to enormous tax savings, but also not only for yourself, but for your future generations to come. So the first one I'm going to talk about is a step up in basis. So when a person receives an asset, and this can be something like an investment account or real estate, after the benefactor passes away, that asset can often receive what's called a step up in basis, or the market value of the asset at the time of the benefactor's death. So there is an important caveat here. The beneficiary of that asset has the option to take the step up in basis from the date of the benefactor's death, 6 months after the benefactor's death, or not at all. There are pros and cons for each option, but it is really dependent on what the beneficiary wants to do and what makes the most sense for their situation. But again, there are options in that scenario. But what you see here on the screen, this picture is under the assumption that the beneficiary is going to take that step up in basis on the date of their benefactor's death. So we're looking at Zach, and he buys stock in a company for $1,000. And we're actually going to follow the top half of this graph. So again, he buys the stock for $1,000, and a few years pass and Zach eventually dies, and you inherit that stock from at Zach's death. And again, this is worth now $5,000 when you inherit it. Because you inherited it when it was worth $5,000, you now have the option to step up your cost basis to the value of the stock at Zach's death, so $5,000. So say the next day you turn around and sell that stock for $5,000, you don't have any capital gain or tax due. And contrary to that example, say Zach had gifted you that same $1,000 stock when he was alive, and when he had gifted it to you, it was worth $5,000. If you had turned around and sold that stock at $5,000, you would have to pay tax on that $4,000 capital gain. So the caveat here is it needs to be an inheritance for the step up in basis.
And these rules change from state to state too. So we're presenting from California today, and so we're in one of the few, there's a handful of states that have double step up in basis. We're one of those. Some states don't have that. And I think there's important caveats here too, where there's, revocable or irrevocable setups. The rules change on that. And I think that these are common scenarios, especially for different kinds of inheritances that we'll see, or even strategies. So let's say you're on the other side, you're not an accumulator, you've already accumulated your wealth. You're thinking about selling something to gift now or something like that. Oftentimes it can make sense to hold off on that and let that step up in basis play out for the next generation. Another thing I'll say too before we leave this one is this is coming under fire at the time of this webinar.
Yep.
And it is I'm sure we'll get some questions on that. We'll see if this even still exists. But as of right now, it does, and it's a huge part of estate planning. So.
So in other words, there's potential that stepped-up basis could go away.
Yeah, and maybe not entirely. I think there's a lot of stuff that could be passed, but at least a portion could be changing, if not all of it. Yeah. Mm-hmm. Okay, and then I'm going to talk about some charitable structures here. And so the first one I'm going to talk about is a donor-advised fund. And I love this graphic. It's basically a combination of give, grow, and grant, right? So a donor-advised fund is like a charitable investment account, but for the purpose of supporting organizations that you care about, right? So like when you contribute cash, securities, other assets to the DAF, you're generally eligible to take an immediate tax deduction, right? So you can see the orange color there, contribute, and then receive deduction, right? And those funds can be invested, and there's that grow section of that graph, right? So the donor-advised fund's receiving those assets, oftentimes as appreciated assets, of course, on purpose, right? And then you have the administration and the investment side of that grow section, and then you're giving to charitable grants, right? And the reason why these are so popular is, number one, it's very simple, it's low cost, it's very effective. And then also too, it's an incredible strategy where you're rewarded for being generous, because you know, I will often see this play out is, let's say you have XYZ stock and you've had it for a long time, and maybe that basis is really low, right? We just talked about cost basis. Maybe the cost basis is $10 and per share, and now the share is worth 200 or something like that, right? And so instead of having to sell, realize the capital gain, and then donate, you can just donate right off the bat and take that appreciated assets and put it right in, which for sometimes that's the same thing, right? But what a donor advised fund does, that's not always the case though, right? So you're altering AGI and MAGI when you do that kind of thing, when you liquidate and then gift a lump sum. This completely circumvents that and then just goes straight to the DAF, which is great. The second one is a charitable lead trust. And so this one, you can kind of see on the screen here, it's an irrevocable trust designed to provide financial support to one or more charities for a period of time, and then the remaining assets eventually go to family members or heirs. So you have the donor, right, the first step, and then you have step one would be gift of property, so you're giving it to that irrevocable lead trust, right? And then you have fixed or variable yearly payments for a set amount of time, so the charity's getting it up front, but then the remainder goes to heirs, or sometimes even the donor themselves back, depending on the time frame, right? But oftentimes it's family heirs. So that's an interesting way when you're alive to see charities receive that, right? And then your heirs still get something, whatever's left over at the end. And then the last one is I think a little more common, is the charitable remainder trust. And so this one is basically the flip side of the CLT. So the CRT is you make a contribution, step one. And then step two is you receive a tax deduction, and this kind of assets you put in, there's all these different rules around it, but you receive a partial tax deduction, and then you can receive an income stream back from that asset while you're living. There's even more complexity there where you can include other people involved, you know, as the beneficiary layer. But then at some point when the beneficiary layer passes, then the remaining amount goes to charity, right? So you can split it between multiple charities, of course. And so you kind of see how those two are somewhat flipped. You have the CLT, then you have the CRT, where the charity's either getting it first or getting it after, right? Lead or remainder, right? And then your heirs or yourself flip-flop in that equation. And by the way, sometimes donor advised funds can actually be used in tandem with CLTs or even CRTs. And so that's not like you have to pick between the three. Normally someone's going to have some, you know, a combination of these are also common as well. And then the last one is an Islet. And we chose an Islet. They're not as common right now. And the reason for that is because of how large the exemption is. I guess to set the stage before I even talk about an Islet, everyone has an estate exemption essentially, which amounts to an amount that you can pass on either while alive or after you pass, to where you can use that amount and not have to worry about taxes. You still have to record it, but you don't have to pay any tax on that. So that's your exemption. And so when exemptions are very high, like they are right now, it's north of 22 million between two people. So everyone has a little more than 11 million right now in exemption. You see, when you combine a couple, you got 22 million. And with the proper estate planning, it's portable. And so what an Islet does, though, is that's not always the case, right? It's been, even in the recent past, it was as small as 1 million. And so the number oscillates over time. And again, this one could change in the near future as well. There's a lot of talk about that. So that could happen, and you could see maybe islets keep becoming more popular. So let's break down what's actually happening on this schematic here. So you have the grantor, right? It's you, the person here, and you're gifting annual premium payments into an irrevocable life insurance trust. And so if you're wealthy enough to be worried about exemptions, you're trying to limit the estate tax upon your passing. And so one great way to do that is to use the annual gift exclusion and give to future generations while you're still alive. But in order to get the Islet involved, you have to use what's called crummy notices. And crummy notices are basically just a fancy way of saying, as the beneficiary, I am waiving my right to this gift. I recognize that you're trying to give me this gift. I'm going to waive that and let that gift go to pay premium on what's inside that Islet. And what's inside that Islet is often a second to die permanent policy that's going to last until the grantors pass away. And then that Islet's going to pay premiums, right, to the insurer to keep that life insurance contract intact. And often it's very large amounts. And then upon the second death, you have the insurer paying the death benefit back to the Islet, and then that Islet can give those proceeds tax-free to help the beneficiaries deal with estate taxes, or even just pass on money tax-free, right? And so it's a complex kind of wheel here that happens. But what's interesting about this is that it's almost like reverse investing. So, like, what I mean by that is, let's say Adam and Allison are at this stage of life, and they're paying for even math, let's just say $10,000 in premiums per year for this policy, and that $10,000 buys them an even $5 million in death benefit, right? So if Adam and Allison in this scenario were both to pass in a tragic accident early on in life, let's say after 2 years of paying the premiums, then they paid $10,000 plus $10,000, 2 years of premiums, or $20,000 total into the Islet. But then that Islet, because they both passed, receives $5 million in this example.
Tax-free.
Tax-free. And so the IRR on that is enormous, and it's thousands of percent. So 20K turns to $5 million just like that after 2 years. Now, I could flip that though. Hopefully, Adam and Allison live a very long life, and let's say they've lived for 50 years, right, or something, whenever they set this up for a long time after that. Then they would have been paying $10,000 that entire time. And you see, the longer they live, the IRR decreases dramatically, especially it kind of starts to go the negative compounding the other way, right? So if they live long enough, maybe the return on that is, low single digits after many, many years, many, many decades to the beneficiaries. But again, just something to kind of be aware of as a tool for yourself, especially, let's see what happens here with these proposed law changes. And if something does happen with the exemption, I think you'll see these become a lot more popular.
So really quick, just for the sake of clarification, let's pretend we had somebody where they had a large enough estate upon death that they have exceeded the estate tax exclusion, right? So that would combine their about $23 million total if you combine both their exclusions, right? $11.5 million each
currently,
approximately currently. And let's pretend that happens, and they did not. They had the life insurance policy with the additional $5 million, but it's not inside of this Islet, this trust. Then what would occur in that case?
It's a great leading question, Josh. So what Josh is getting at is the difference between the revocable and irrevocable sides of an estate. And so if it's held on the irrevocable side, then it's passing outside of the estate exemption calculation. But if it's just held normally on the revocable side, the living side of the estate, then that will be included in that amount and subject to estate tax.
Yep. So in other words, if I have $23 million between the two of us, and we pass, and we had a $5 million life insurance policy, we now have $28 million, of which $5 million is estate taxable, or has an estate tax liability to it. Whereas if we set up the Islet, exact same scenario, but now that $5 million continues to pass through on a tax-free basis, which is what tends to be so great about insurance in general.
Yeah.
I'm going to kind of go back. There was a great question that was asked early on that I think everyone could actually benefit from. And it had to do with when we were talking about the IRA aggregation rules.
Oh.
And there was, in that slide, there were pieces that talked about pre and post tax.
Mm-hmm.
And just to kind of summarize, there was kind of two pieces of the question that came in here, but to summarize really what the question was, do you guys kind of mind just kind of clarifying pre and post tax contributions that would happen, whether it's inside of a 401k or an IRA? You know, why would there be post tax contributions in there?
Yeah. Well, okay. So in this example of the IRA setup, there could be post tax. You know, I'm gonna steal Megan's sundae analogy. I really like that. So if the cherry on top of the sundae is the tax deduction, the actual sundae itself is the tax deferred growth in this setup, right? And so you could forget the whole Roth conversion for a second. Why would you just make a non-deductible contribution to an IRA? You'd make it for the tax deferred growth over many years, not having to pay tax until you take it out, right? It's a powerful tool in its own right. What's cool about the Roth conversion, just taking this analogy probably way too far, is maybe the Roth setup can be thought of as kind of the hot fudge being added. There's other toppings can be added in because now you're getting a little bit of both, right? You're getting the tax deferred growth, but then also you're getting tax-free pull out at the end of that.
So theoretically speaking,
yeah.
right? Let's just pretend maybe I have a 401k. I've maxed my 401k. There's $19,500 that's in my 401k.
Yeah.
But I got a bonus and I have extra money and I don't need it, and I'm totally content to say I'm not going to touch this until I get to retirement anyway. I can make a non-deductible contribution into an IRA, a traditional IRA, and while I won't get a deduction for what I put in there, I can still get tax-deferred growth on those dollars.
Absolutely, and I think the timing of that makes it, is important. But like you said, yeah, all the way up until RMD age, which is currently 72 plus. So, that can change too. But, yeah, good question.
Yeah, great question. You kind of already answered it. There's a question that came in asking, will the tax-related strategy still be relevant under a new Biden administration? I think you kind of already addressed that. Is there anything additional you want to add on there?
Yeah, I think it's important to note that all that stuff is pure conjecture at this point. There's a lot of stuff that's been proposed, and that's just how these things work, right? I mean, if there's maybe a few of those things actually get through. I can promise that we'll be doing a deep dive into that. So whatever does get passed, expect to hear from us on a one-on-one or even group basis. So, yeah, it's kind of hard to say, obviously.
Yeah, I think this is part of the reason why there is investment and investment performance and looking at what investment options we want to buy, right? We look at that side of things, but on top of that, so much of wealth management over the course of your life deals with appropriate planning to mitigate the amount of taxes that you're giving away. Mm-hmm. Such a huge part. So things are going to change. We all know things are going to change over the course of time, regardless of who's in the current administration. And so part of the planning process is to do a good job of positioning yourself well and taking advantage of what's available at that time.
Absolutely.
This easy question, right? Are there any limits to Roth conversions?
Go ahead, Megan.
There's not, actually. So again, this really depends on your situation and how much you want to convert and what makes sense for you. But you can convert any dollar amount that you want, essentially. So again, you want an advisor and a planner to help you prepare for that, but it's not limited.
The question is, what if I work for two employers who each offer a 401k, but I am not self-employed?
Oh, okay. So I'm going to interpret your question as, so you're not doing anything kind of side hustle, you're not 1099, you have literally two W-2 different jobs or something like that, right? And so in that setup, that's by the way, that's really cool because you assuming both employers have some kind of match, then what you could do is you could use the 402G contribution limit, spread it out between the two, and get as much of a match as you can. So like, let's say hypothetically, it takes $7,500 under one plan and $10,000 in the other plan to get the max match for whatever you're making, right? Yeah, that's totally fine. You could do $10K and $7,500, and then you could just pick whatever remainder into the other 401K. But that way, you're double dipping on the company match from both sides, which is perfectly legal. And then you can fill out the remainder, if you're able to max it out.
That's a great question.
Yeah. And that goes for more than two, hypothetically, right? Same premise, just across the board.
All right, and so while Megan backs up on there, we can kind of talk through the next question, and then we'll backtrack onto it? Never mind, it's up.
Yep, of course.
Too late.
You see that. So the reason I had the visual, I think it's just so much easier to see the different colors here, right? So you have the post-distribution gain, the NUA gain, and the cost basis gain, right? So again, just to normalize the situation, forget NUA completely. Just what happens when you normally take out from a 401k when you retire? It goes into investment ordinary income, right, on your 1040. And so this separates that to where some of it's ordinary income, and then a lot of it potentially could be NUA gain, right? And so you have the cost basis, which becomes ordinary income, and then the NUA gain is the long-term capital gain. So that's the benefit. It's not like you're magically erasing taxes from it. You're just swapping ordinary income for capital gains after you've rolled into the non-qualified side.
And I don't know if this will help everybody, but I like clarification. I think it's always a good thing. So for anybody else that's not trending on to what's happening on this slide here, Chris kind of talked about that color-coded piece, thinking about it as one stock, right, at your employer, right? And so the way I like, the blue is what you paid for it. The orange is the amount that it grew while you were employed, right? And then assuming that you did this NUA, the gray is the amount of growth that occurred after you retired and took it as NUA. Mm-hmm. All right. If you had left it as a traditional rollover and did not take the NUA opportunity, there essentially really is no color coding when looking at the taxes. It's all taxed at one rate. Okay, so hopefully that's kind of helpful as far as a point of clarification for if anybody's,
And please seek us one-on-one. We can obviously go as deep as you need.
Yeah. Let's see here. We got a little bit more time. We got about 5 more minutes left here, and I have a couple of questions left. So, if I do not have any phantom expenses, should I be looking for ways to create them? That's an interesting question.
That is an interesting question. I'm going to say, in general, the answer would be no. In general, again, because it really is. Oh gosh, I use the Sunday analogy again. It's the cherry on top, or maybe extra credit is the phantom expense. So it's not the main course of what you're trying to do. You should not just grab a rental property just to get some depreciation. It's small in the grand scheme of things. It's just nice to maximize your investments. Mm-hmm. So that's just one small piece of that overall. Right? You're buying the rental property. Go back to part 2 in this series to continue to build wealth, cash flow, build passive income, etc. But the depreciation is a nice added benefit. And Megan said this earlier too, right? You can tell by the tax codes what they're trying to incentivize you to do. And so they are incentivizing you to provide housing, shelter, etc. for your fellow humans, and they're giving you a tax break in the form of depreciation, write-offs, etc. And so that's yeah.
The question is, why would you pick a charitable lead trust over a charitable remainder trust and vice versa?
You take that one.
All right. Well, so it's a great question. So let's just kind of recap the way that these two. There's some minor differences between the two, right? And that's the answer is really in the details here, right? So if I'm looking at a charitable lead trust and I'm the donor, right? So I take these assets and I put them in the charitable lead trust. And we're just going to say stocks and bonds. I'm going to put some stocks and bonds into this lead trust, the charitable lead trust. Now, while those assets are in there, there is a fixed or variable yearly payment that is going to the charity while I'm alive. All right, so I'm alive. I get to see the benefits of these dollars pay out to that charity while I'm alive. I also got this tax deduction for the funds that I put into the trust. Now, when I die, the annual payments that are going to the charity stop, and whatever is left inside of the trust go to whoever my designated beneficiary is, right? So if I have kids that I say, you know what, my kids are fine while I'm alive, I'm taking care of them anyway, right? But when I die, I want them to get these funds. But while I'm alive, I would like to see this charity get the benefit of these funds while I'm here, right? So now I've kind of got a good reason behind why I would want to plan that way. All right. Now let's go the next one down. If I was using a charitable remainder trust, okay, In this case, I'm the individual. I make the contribution to the charitable remainder trust. Let's just pretend that I am at retirement age, and this is part of my retirement plan. So I'm going to take these funds, same stocks and bonds, but in this case, I'm putting it into the charitable remainder trust, and instead of these this fixed or variable yearly payment going to the charity, they're going to actually come back to me in the form of an income stream. All right, so I'm getting this income stream as part of my retirement income. I got my Social Security. Maybe I have some pension income. I have money coming off of my stocks and bonds. I have some rental income, and I have this income coming from the charitable remainder trust. Okay, when I pass away in this case, what happens is that income stream stops, and the charity gets to keep whatever is left over inside of that charitable remainder trust. It could go to 1 or 2 or 3, multiple charities. All right. So in this case, it's one of those where I'm saying I don't really need the assets that are in here to go to any beneficiary other than the charity. Maybe I don't have any kids or have any family, and I'm just saying, you know, I need this income while I'm alive, but I want that charity to receive this once I pass. So hopefully that kind of brings some clarification in there. They're great tools. They serve different purposes depending on the situation. This last question could be answered relatively quickly with our last minute that we have.
Okay.
Right? And it says, do I need to set up the irrevocable trust before I purchase the life insurance? I think another way of saying this is, if I have life insurance now, this is how I normally hear it. I already have some life insurance. Can I put my life insurance policy that I already have into an Islet after the fact?
No, you're going to want to set up the Islet specifically first. So administratively, just easy. It's Islet first, and then kind of piece together after that. That's the best way to go about that.
Okay, so that brings us to the end. I want to go ahead and say thank you to everybody for joining us today. I hope you enjoyed part 3 of this 4-part wealth building series. The last part 4 will be coming up here shortly. You will receive an invitation to join us for part 4. The replay video of today's session will be posted to the website in about a week. And again, please stick around and complete the survey in the end so we can make any changes that you guys have suggested for us. Happy New Year, and we'll see y'all next time.
Happy New Year, everybody. Thank you so much for attending.
Thank you.